All right, thank you. Hey, thanks for getting on. This is our third webinar. So we feel like we got this down pat. We're happy to, again, get this to everyone. I think it's a real important topic for college students at any age. I know some of you might be freshmen that are like, I'm not going to get a job for a long time. It flies by, trust me. And those of you who are nearing the end and looking for that job soon, this will hopefully be very beneficial and you'll get some good foundation. As I've said in the other meetings, it's just the tip of the iceberg. This is really just an awareness to get you thinking. There are resources on our Canvas page, the Billiken Athletics Canvas page that I've got out. I'll send a link out to that tomorrow. And then the folks you're about to meet are a great resource at Northwestern Mutual. Great partner of the NCAA, as well as us here at SLU. They do a lot with us. They'll do some other, I have a feeling Carrie is going to want to do some other, career-minded workshops with us, as well as sponsoring our etiquette dinner for seniors that we do every year. So we're good friends with them and want to keep that going and help you guys with what they offer. So I'll go ahead and turn it over to Carrie Lemke and Brian. She'll introduce Brian Moore, our advisor from Northwestern Mutual, who's going to cover most of the material. If you have any questions, put them in the chat. Carrie will tell you too, but she'll monitor the chat and help include those questions. So Carrie, I'll turn it over to you.
Yay, thank you so much, Roy. Excited to be here. Third time, best time. So excited to hang out with y'all tonight. So it's my third time I'm gonna ask, but do not be afraid to turn on your camera. I know y'all are so pumped to hang out with us this evening, but feel free, turn them on, laugh at our jokes tonight. We'll make it fun. Hopefully some point of interaction. And then also, like we've said before, if you have any questions, you can always unmute yourself, but if you'd like, totally put them in the chat bar and I will make sure that they get answered. So like I said, very excited to hang out with y'all tonight. So like Roy said, my name is Carrie Lemke. I am the Director of Campus Selection for our offices here in our Clayton office and actually our Chesterfield Valley office a little bit further from campus. So really I run and help recruit and interview for our internship program. And I'll talk about a little bit about that here at the end as we wrap up. But I'm excited today to be joined by my colleague and partner, Brian Trojan from our Clayton office. He is an advisor with us, and really he works with his clients to help them reach their goals of financial security, right? Whatever that means to them. And so really here at Northwestern Mutual, that's what we do. We work with our clients with their holistic, comprehensive financial planning. And the reason I'm telling you all this is I want to give us some cred of why we have the audacity to be here with y'all tonight, right? What advice can we give? And so just want you all to know there's no time better than today to start on this stuff, right? And so Brian's going to give you a lot of info. We hope that you could take 1, 2, 4 things away from it tonight, but if the biggest one, and I'm sure we'll all reiterate this, is to start today, right? So I'm going to turn it over to Brian, but like I said, any questions, if you need anything, just pop it in the chat, and we're excited to be with y'all.
Awesome. Well, thank you so much, Carrie, and excited to be with all of you student athletes this evening. Appreciate you making the time in your evening to listen to our presentation, and hopefully, like Carrie said, you'll have some takeaways. I'll share my screen in a moment and go through the presentation, but like she said, please use the chat box or please interrupt anytime if you have questions or you want to dig in. But yeah, I'll jump into the presentation here.
Brian, sorry, I muted you. Unmute yourself. I was trying to admit somebody and when you shared your screen, it put you on my button.
I didn't think I was going to say anything that offensive that early, Royce, but I appreciate it. No, we're off and running now, so sorry about that. So the one thing I wanted to say before we jump into this for you all is just to echo Carrie's statement earlier. It's not too late to start. You guys are all obviously sort of not even in your careers or starting your careers. A lot of this Finance 101, a lot of the information that myself and my fellow advisors are going to give you and share with you tonight are the same conversations we have with people like my age and your parents' age and people who are entering retirement who have made it that far and have no clue what's going on in their finances. And a lot of the things we're going to share with you today are the same questions that they have, because people, don't get this education in school. They don't talk about it in their families because sometimes money and things like that are taboo, or, they're things they just, have either been scared of or not been interested in learning about. Really what we're talking about is the ability to have well-being, mindfulness, and financial freedom in the future. And so this is, I'm so happy that you're all, looking into this stuff in your late teens and early 20s, because this is really valuable information. And so, if you want to know more, if you have questions, certainly don't hesitate to ask, and I'll share my information. If you have questions after this, you can obviously reach out with me, or we can even meet together if that's something you're interested in. I'm just going to pop through some of this. I know Carrie mentioned it, but Northwestern Mutual, we're one of the big guys. We're a big financial firm. We're on the Fortune 100 this year. Actually, I think number 90 this year, the 90th largest company in the United States. And we do, a full suite of financial services. Like it says there, we're helping our clients make smart choices. And we really use a customized plan. We're going to make sure that we are doing planning for our clients to help them meet their individual goals. We're not here to tell them what they should be doing. We want to find out from them as individuals what matters to them, when they want to retire, what type of life they want to have, how they want to contribute to themselves and their family and their community. And once we know what those things are, we're going to help them meet those goals. We do that obviously through a wide suite of financial instruments, things like insurance and investments, and lots of different ways to do it. But we look at a lot of different things. We're doing that. Let's get a couple of these. One of the things that we really talk about and we want to focus on tonight is just sort of the behavior of humans and what we do with plans and sort of the seasons of our lives. Not knowing just what we're doing, but why we behave the way we do really helps us gain an understanding of our money management. Obviously, we have sort of one side of our brain that is going to be very rational. We're going to make great decisions. We're going to be able to pick up and learn new things, and then also be able to choose the right financial products, the right career, the right amount that we should be saving all the time. But we're also, the other side of our brain is also, that we're people, right? And that there are things that are going to derail us from some of that rationality and some of those maybe good choices. We can definitely make errors, make emotional decisions. I know that we're all prone to those. It doesn't go away when you get older, guys. Sorry. But certainly can act in ways, that are to our detriment or not in our well-being. So, that's something that we have to work on and plan for, because there are going to be things obviously within our control and outside of our control, and creating great systems and plans is a great way to combat that. Some of the fundamentals that we want to talk about and that we look at when we're making financial plans for our clients, and that we want to look at in just your overall financial health, is really the main objective that we talk about with our clients is having that freedom and that freedom to choose. And when we talk about freedom, it can be in many ways, right? This can be the freedom to retire when we want to retire. This can be the freedom to spend our leisure time the way that we want to do, that we want to, right? Go on the vacations that we want to do, spend the money that we want to on the home that we want to live in, the neighborhood we want to be in, the car we want to drive. The choices that the money and the financial freedom allow us are really unending. Money is not something that's going to solve every problem in our life, but it's certainly going to eliminate a lot of them, right? And so, not having money becomes a big problem. And so we want to create, an ease and a peace of mind for our clients where there's plenty of, things that we can worry about and have issues with in our life, whether it be, health or interpersonal issues. If we can eliminate money from one of those, that's going to help save a lot of strife and a lot of challenges later in life. Like Carrie said, it is never too soon to start. And in fact, the sooner you start, the better. Whether we get these financial disciplines in place early, that's a great habit to have. But also, as we'll see a little bit later in the presentation, the sooner we start, the easier it is. It's a much easier hill to climb when we start when we're your age. Simple steps again are going to be the way to do this. We're not going to get in any very complex or convoluted concepts tonight. We're really just going to talk about doing the basics, really getting a good understanding of where we can save and the places that are most advantageous for us. And unfortunately, there isn't a magic pill. You can win the lottery. That's great. Come see me, and I'll help you invest the money if you do. But for most of us, we don't have a magic pill or a huge windfall that's going to take care of us. Maybe you guys are going to mint that new NFT that's going to be worth billions tomorrow. But if you don't do that, then we'll certainly have to create the right behaviors that are going to create wealth for you long term. Pen here. All right, so there's 5 key actions we want to talk to you about that really are kind of the pillars of financial security. And don't worry about looking at that small print. We're going to move on to a slide that covers each of them here in a second. First, the one's pretty easy. You know, this is not going to surprise anyone. We need to save our money. You know, we need to save more than we make. Pardon me, more than we spend. We want to build up our savings today and cover life's goals and surprises that are going to help you afford the life you want for tomorrow, right? We always need a little bit of nest egg. We need some money in the bank. How much should we allocate? What do you think we should be saving per month? Anyone want to shout it out or throw it in the chat? Anyone got a guess? Per month, what percentage of our savings or what percentage of our income should we be saving? Anyone know? Do we have any guesses, Carrie?
I know, but I want to see if a brave student really wants
brave
to
student. I mean, just one guess in the chat. I mean, that's all. It's somewhere between 0 and 100. That's the guess. No, nobody.
25.
Somebody?
Someone said 25.
Oh, that is really, really good. Actually, I love that number because there's actually a range. The number we have here is 20, but that is truly the answer. 20 to 25% is truly what we want. So if we can do 25%, that is right. So kudos to our person who came in with the right answer. Maybe they're a finance major or an econ major or something like that. But that number sounds simple enough, right? Sounds like 20%. Okay, well that's not bad. For every $100 we make, we need to be putting aside 20%. Seems easy, but very, very, very small percentage of the population is doing anywhere near 20%. But that is the goal is to be in that 20 to actually 25% range right now. All right, how many of you have an emergency fund? Obviously, we don't need to answer. When we talk about an emergency fund, what we mean there is really liquid cash that we have, months of savings or amount of savings that'll sustain us for several months worth of bills, right? We're always going to have unexpected. And many of you guys have heard this. I know this was a big study done. I think the Federal Reserve did this study a few years ago, and it's pretty shocking, pretty scary. About 40% of Americans can't cover a $400 expense without using a credit card or borrowing money. Yikes! This isn't 40% of broke college students, right? This isn't you guys. This is everyone in the country. This is the whole country, 330 million people. So that's over 120 million, 130 million people in this country can't cover a $400 expense. That's a pop tire. That's gosh, I hope their air conditioning doesn't go out. That's triple that cost. And so the things that are going to come up and sideswipe us and those extra bills, we want to be able to pay for those. And so being able to handle an unexpected expense is what we talk about having an emergency fund for. And that's really just cash set aside in like our savings account, right? And the amount that we want, I agree with this and disagree with this somewhat, but the general guideline is about 6 months of living expenses. That's going to change depending on who you are. Some people need more than that. Some people need less. What I really think is that, oh, pardon me, my chicken scratch here. 3 to 12 months is appropriate depending on who you are and what your situation is. If you're, a single person with a steady income and you have great job security, you work, you have a salary job where you're not like on commission, you could probably get away with more like 3 to 4 months of cash on hand as far as your living expenses, your total expenditures per month. But if you're in a more volatile situation, if you're someone who works on commissions, if you are someone who, maybe you have a spouse and children at home and you have a more volatile situation where more of those expenses are going to come up, maybe we need more like that 6 months or maybe 9 or 12 months if we have, a lot of people depending on us and we have a single income, or like I said, if we have that inconsistent income from things like bonuses that we're relying on, or commissions that are inconsistent, people like realtors or salespeople that are going to get the majority of their income from sort of lump sums. They're definitely going to need more money than 6 months. But 6 months is a really, really nice number to be at. And for you guys, if that number seems daunting, probably right out of school with low expenses, at least 3 months is a pretty reasonable number for you. But we definitely want to have that cash on hand so that we're not creating debt for ourselves and we're not getting into a situation where, hey, we're in over our head and not able to pay for some of the simple stuff that is inevitably going to come up in our lives.
Brian, I'll give you a little breather.
Yeah.
A couple of things that come to mind here from the 40-something-year-old guy. I think you're going to talk here in a minute about saving for retirement, right? So that kind of hopefully happens through your employer, and that money may come out before taxes, right? It goes into a fund, and you don't even know it's there. So hopefully this emergency fund is for the things that come up that you need to do, right? So it's great to have that 3 months for anything that might just, the car broke down, something happened, right? And it costs you an arm and a leg. But I've learned as an adult, all the adulting I've been doing, you've got those needs, like this thing has to happen, right? But then there's stuff you want to do too. So at the young age, you might want to go to that bachelor party in Cancun or whatever, that costs a lot of money. So you kind of need to save money and maybe have a couple of buckets where this is my emergency fund, and then this is my fun fund. Because you don't want to have to put the fun on the credit card or put that stuff really adds up and can put you in a hole. So ideally you're saving in both of those ways so that you can cover that stuff. I'll say too, again, you also want to have the needs, like the thing I really, really need. And we kind of know what those are a lot of times. But I know as a young, right out of college person, I was I think in 5 or 6 years, I was probably in 12 weddings. Everyone cost me at the time $100 a tux. And so it adds up quick, right? It's all those friends you've got that want you to be in their wedding, it's going to cost you, and you got to get gifts and all that, right? So young adult stuff costs money, right? So make sure you're prepared for those things, and you're not too mad at your friend for making you a bridesmaid that you can't afford to do. Sorry, I'll turn it back over to you. Carrie, you want to jump on that?
I was going to say, I am feeling that right now. I'm at the later end of that, where we've been in millions of weddings, and now I'm planning a wedding. And Lord knows that is, if y'all talk about spending money, man, that is crazy. So I would totally echo that.
Yeah, Royce, you couldn't be more correct. Having buckets of savings is really smart. And, it's very, very easy to get some credit and throw that bachelor party or that weekend trip to on the credit card and think, I'll make it up when I get my promotion next year, or when I get a raise. And that's how we see young people get in a lot of trouble and a lot of challenges if we start living on credit and living beyond our means. And you're absolutely right to suggest sort of that fund. Good way to put it, along with sort of that emergency fund. And, again, the emergencies for you guys are going to be smaller, right? Because we're likely not going to own a home, right? We're not going to have that, water heater go out, or, if we don't have kids, we're not going to have that, emergency trip to the hospital or ER that's going to cost us. But we definitely still want to have some money in reserve that, again, we can live for today with, and then also be thinking about, when we have that rainy day fund as well. So that's a really good point by both of you guys. And you're certainly going to see those wedding expenses and the being in bridal parties, man. I wish I could get away with it for just $100 a person, because man, you throw in any travel in there, or gifts, and like you said, that hotels and things, that gets really pricey really quick. All right, so spending, obviously this is the fun part. This is the part we're all good at, right? So we want to manage the money you have to cover what we need and know what we owe and what we want. Anyone track all of their expenses? Anyone good at this yet? Do we have any accounting students in the mix yet? Right? There's a lot of great apps. I know Mint is a popular one. They're owned by Intuit, and their software is really good. It'll allow you to put all of your credit cards or debit transactions sort of all in one app, and they'll allow you to track it, or they'll track it all for you. That's a popular one, but I'm sure that there are dozens of other apps out there, and these tracking softwares are really smart, particularly if you've never done any budgeting for yourself and kind of understanding what that looks like. I know I was not a good budgeter when I was in college. I wasn't really thinking about it. A lot of my bills were sort of just taken care of, or things that I didn't really pay much attention to. And as you guys are, either some of you are kind of on your own as far as this budget, and some of you aren't, as you go off and you're starting to kind of lead your own lives outside of kind of the confines of college. For many people that really hit them hard. And so having an idea of what the budget is and getting an idea of your cash flow is going to be really, really expensive. And so using a tool to track your expenses is something I'd strongly recommend. Like I said, here we got a kind of a picture of an app on what's going in and what's going out. knowing what to anticipate. And then, never forget that there's a couple of things that, we might only pay a few times a year. If you do your car insurance every 6 months, that's going to be a big expense. If we have things like property taxes, depending on what state we live in, you'll have extra expenses that are going to pop up as well. So want to work on budgeting, and that's a really good exercise for you guys if you haven't done it. Get an idea of sort of what your monthly budget is, and knowing what your expenses are, and then knowing what to expect as far as what you need to cover that. All right, so we want to look at how we're saving and investing and looking at all of our money. So if we have 100% of our money to spend, we already talked about sort of the first part, that saving and investing, making sure that we're putting money away for the future, whether it be in that emergency fund, or we're starting to invest in growing our money in some of those fun things like the stock market or cryptocurrencies or things like that. We know we want about 20% of our money going there. The bulk of our money is going to go towards the essentials, right? Living our life today. That's going to be things like our rent, our groceries, our food, any insurance that we have to pay, paying back our loans for many of us. Hopefully you guys, we got a lot of athletes in here, hopefully got some good scholarships, but I know SLU is not an inexpensive place to go. So I would imagine there's some loans out there for some of you. And so, paying that back. And if we have questions on that, we can certainly cover them. But we know that's going to be the bulk of our money. That's going to be about 60% of our money overall. And then really we want about the same amount that we're putting into savings to be toward our discretionary expenses. This is going out having fun. This is shopping, the stuff that you need, your personal care, the Target runs. I know that's where, a lot of my money goes, at least where my girlfriend spends it. But that, that'll be a lot of things. And then, also things like dining out, right? Not just our normal food, but your other expenses. And that really ends up being, a big point where we're not able to save because we're really overspending on our discretionary expenses. You'll also see some overspending on your essential expenses as well. Like, hey, I can technically afford this new apartment, but is it really reasonable for me? Understanding that, hey, when we look at that budget, and understanding when you get these first jobs, maybe out of school, knowing what your paycheck's going to look like, after we actually get our taxes, right? So if we're making $40,000 out of school, well, what does that really look like after our taxes are taken out, and getting a good understanding of that are all things that you want to kind of sit down with a pen and paper and understand it. We'll dig into that a little bit further when we talk about taxation. But using this 20-60-20 model and method is really a great place to start and a good guideline for success. And it's okay if we can lock this in a box, right? If we can always make sure that we're saving 20%, it's up to you. If you want to trade off, if we want to make this 65 and that's fine, but then this has to be 15, right? So we want to make sure we're not giving up one, we can rob from one to pay for the other, as long as we're continuing to save our money, and keep that 20% kind of as a sacred number for us. If we're giving up on those and we're not living for today, we're just not going to have as many choices and that freedom that we may want for ourselves in the future. And so that would be my strong suggestion, is to follow this 20-60-20 model. Growing our money. Obviously, this is a really fun and exciting thing when we talk with our clients. This is generally what they're the most excited about as well. So we want to invest in ways that match our goals, our timelines, and our risk tolerance. This is maybe a little bit hard to see, but hopefully you can see this. This is just the value of starting early and the magic and power of compounding interest, right? This is a chart showing us spending or investing $100 over time at a rate of about 6% return. We use 6% return because that's a pretty common projection that we've used to represent the returns that we're getting in the stock market over time. Over the last 10 to 15 years, it's probably been closer to 7 to 10%. If you've been looking at the markets for the last 3 months or so, it's pretty rough. I see Roy shaking his head. He must have looked at his 403B statement this morning or something. Yeah, our buddy Vladimir over there in Russia is causing some trouble in the markets right now. And so we know we're going to have those tumultuous times, but we know over a long period of time the market is going to go up. It never hasn't. But there are going to be challenging years. We know in the last 100 years, 77 of the last 33 years have been up, which is pretty good. But that means we've got 23 down years. If we look at 5-year increments in the market, we have 85% of the time it's up. But over a 5-year period, about 15% of the time it's actually been down. we've never had a down 15-year period in the market. So we know a long-term, if we're investing in the market, it's going to be really, really fruitful for us. So you can see here in the diagram, investor A is someone your age, actually a little bit older than probably most of you guys. They just started with $100 a month, very simple, $100 a month, and they invested from age 25 until normal retirement age of 65. So they invested $100 a month for 40 years, $48,000 invested, and that's worth over 200 grand 40 years later. Someone who waited just 10 years later to start doing that, investor B in the green, has 100 grand less. And then investor C, who didn't start until they were sort of middle-aged, 45, has a quarter of the savings starting 20 years less. So the time value of money is really what we're trying to articulate here and show you here, that it's less about the amount that you're putting in, right? This is a small amount, $100 a month, but the fact that they were able to put that money into the market and get the power of compounding interest, the most unstoppable force in the universe, I think it was Warren Buffett called it, compounding interest, was able to create a ton of wealth for them with a relatively small investment. So like we said, never too soon to start, and the sooner you start, the harder your money is going to work for you, is really the takeaway on this slide. All right, so what we're looking at here is some of the vehicles. When we say vehicles, these are the investment options that are going to be available to you. We're not going to dig too much into this, but I do want to talk about some of these as you know, they're common things that you may be seeing as you're starting in the workplace. And the number one I'm going to focus on is a 401k, right? I'm sure you've all heard of that. Many people know what it is. Many people may not know what it is. This is called a employer-sponsored qualified plan. A 401k is just a tax code for investments. What's actually inside a 401k are stocks, bonds, and mutual funds like you could have in any other investment account. But what's special about a 401k is it's offered through an employer. You also may hear of a 403b. 401ks and 403bs are essentially the same thing. A 401k means you work for a for-profit company, and a 403b would mean that you work for a nonprofit, right? But they're essentially the same things. These are tax codes that your employer uses to allow you to make contributions into a qualified retirement plan for yourself. What is really important about these is that if your employer is offering a match or matching funds, if you see that in your benefits packet or in their in their recruiting spiel, if they're offering a match in your 401k or 403b, that is absolutely something 100% of the time that you want to take advantage of, right? The way the 401k works is that you'll defer or choose a percentage of your salary to contribute to your own 401k. The most common choice that people make in the United States is somewhere between 3 and 5% of their salary that they're going to defer into their 401k. We'll just use nice round numbers so that everyone can follow along. Let's say we get a paycheck for $1,000 and we're deferring 5% into our 401k. So before they take out any of the taxes or any of the money for our health benefits or anything like that, before they touch anything, before it's taxed, they're going to take that $50 and put it in our account, the 5% of the 1,000 or $50 and put it in our account. That money gets to go in there completely tax-free. So that 50 bucks goes in here tax-free as we make it. It gets to grow tax-free for the entire time that it's in there. And then when we get to retirement, we pay taxes on that money in the future. What's so important and so powerful about a 401k is if we get offered a match, right? Many employers are going to offer you a match, and they're going to give you two numbers in the match. The first number they're going to give you is the percentage of the amount that you're putting in that they're going to match. So you'll see the most common match in America would be 100% match up to 3% of your salary. That's the most common match we see in America at this time. Some people are way better, some people are way worse. What that would mean is that in this scenario where we're contributing 5%, right? We put in the 5%, they're going to match 100% of that contribution up to 3% of our salary. So they're going to match us dollar for dollar or 100% up to the first 3% we put in. So for the first $30 that we put in, they're going to also match and put in $30. Anything we do beyond 3%, they don't match. So we're going to put in 50, they're going to put in 30, right? You're getting a free $30 every time you make a contribution. And that is an unbeatable return on your money. That first 3% you're getting on your money, you're getting 100% match, right? Some people might do something different. They might give you 50% up to 6%, right? So that's somewhat the same and somewhat different, right? So if they're going to give us 50% up to 6%, we would have to contribute that full 6% in order to get that same $30, right? So in this scenario, let's say we put in 6% of our $1,000 paycheck, or $60. They're going to give us half of that up to 6%. So they're going to match and give us $30 as well. All right. No matter what you do, no matter how big or small their match is, you always want to put in and match at least this number that they have as that second number, whatever they're willing to match up to. Because even if it's only 25% matching, whatever you're getting in returns from them is instantaneous growth on your money. Do not miss out on your match. Start that the first day you're eligible. Sometimes they make you wait, a year before you can participate. Sometimes it's 6 months before you can participate when you get a new job. But if you have a 401k or 403b where they offer you matching funds, do not miss out on 1 penny of those matching funds, because that is absolutely free money and it is a bonus on your salary. You can also look at that when you're comparing job offers, right? Who are the companies that are offering you a better 401k? If one company is offering you a $50,000 salary and the other one's offering you maybe slightly, but maybe one company's 50,000, one company's 48,000. Well, if the company offering 50,000 doesn't have a 401k match, and the one that has a 48,000, the $48,000 salary offers you a 5% match on your salary, well, that 5% bump on your 48,000, that makes up more than the $2,000 difference that you're missing out on the 50,000. They're actually going to pay you more money to work there. So that's definitely something you can think about, when you're comparing, the benefit structures of any of your companies.
I'm gonna chime in for a second and give my 2 cents, because I just love to do that. I would say that's a really good point, and I know we're talking about like the benefit in the sense of the 401k, but I think for any student, and I've spoken about this too, and I've done panels and presentations of like that, but I think benefits is an area that sometimes we don't understand as like compensation value, right? So, your dental, eye care, right, health insurance, anything along those lines, those are an added like bonus at any salary. So I think not only, and I know this is like a whole other thing outside of finance, but just my recruiter hat here, but not only looking at salary, but what the benefits you get attached with those job offers as well is definitely where you can add some value. So that's just my 2 cents. We can keep going.
No, I appreciate it. And thank you for chiming in. Believe it or not, clients ask us about this all the time. And I have clients, when they get job offers, they want to go through the benefits package with us. And they'll ask us, all the specifics about, hey, let's look at this, let's look at the match. They also may have something called a vesting schedule. For those of you guys who, particularly if you're getting into tech, vesting schedule is something you'd want to ask about in a 401k. Essentially, that's how long you have to stay there in order for you to keep the money that they've contributed in their matching. And so that's something else you'd want to ask about, would be vesting. If vesting is going to be part of the stipulations for you keeping those things, but absolutely make sure you're taking advantage of the 401k and 403b match offers that they're giving you out there. That's going to be one of the most important things that is going to be put right in your faces as soon as you guys get jobs here, and definitely something you want to talk about and look at. The rest of it we can kind of get into, and there's other great options as far as Roth is another great way to save. We're kind of paying the tax now. We won't get into the weeds on most of the rest of this, but there is something I definitely want to talk to you guys as well about, which is investing, stocks, bonds, mutual funds. Many of you I know are probably already investors. You've been dabbling with things like Acorns or Robinhood. I know that the investment space has never been more accessible and larger. Even crypto would be relevant to this category as well. Not quite in the same way, as it's not a regulated security, but you're definitely on the hook for taxes that you would have in gains with crypto. And so for those of you who are investing in what we would call non-qualified accounts, which would be brokerage accounts, again, through, whether it's TD Ameritrade, Fidelity, Robinhood, Acorns. If you're able to trade and buy right now and sell it right away, that's a brokerage account. And that's what we're talking about right here. I just want all of you all to be aware of the tax consequences that are going to come along with that. So when we are trading those individual stocks and bonds in particular, and what I imagine what most of you guys are trading would be stocks in particular, we know that there's taxation on these accounts, because these are all what we would consider triple tax non-qualified accounts. So you have 3 tax consequences to worry about obviously the money that you're putting in there has already been taxed, right? You've gotten it, through work after taxes. But you also, even if you're just holding those stocks, if they have any growth or dividends or income from those bonds, if you're getting any dividends or payouts while holding those stocks, you owe taxes on those while you hold them. That's not the same as if it's in a qualified 401k account. So there can be some tax implications if you're getting some mail from Robinhood or whoever you hold your securities with. Don't throw that away. It's relevant to your taxes for this year. But even more importantly than that, if you've sold anything, there are major tax implications if you sold anything, especially if you have made money. If you have made money selling your shares, you are going to owe capital gains tax, either short-term or long-term capital gains tax. And what that means is short-term capital gains are really just relevant for someone who has held a security for less than 1 year, which many of you guys had. If we're day trading, if we're into the meme stocks or anything like that, long-term capital gains are a lower percentage that we pay for people who've held longer, who've held longer than a year. So those are all extremely important things, and many people are unaware that they are owing taxes on their gains. And everything that you owe by April 15th of 2022 is only relative to what happened to the calendar year from January 1st to December 31st of last year. So if you made a bunch of money in the stock market by December of last year and you sold it all, and then you've lost a bunch of money in January and February where the stock market's been no good in 2022, you still owe the taxes for what happened in 2021. It does not matter what's happened in 2022. It's only what happened to that 12-month snapshot. So I've seen a lot of people not understand that and get kind of bitten by some taxes there. So be very, very aware of taxes. Same thing is true for crypto. Again, it is not a security that's regulated by the SEC, but it is sure regulated by the IRS when you turn it into gains. When you earn money from an investment, whether it's crypto or a stock, and you show those realized gains. If you bought it, Bitcoin at 20,000 and sold it at 40,000, those gains are all taxable. So those will be noticed, and those are things that you all need to be prepared to pay taxes on. So make sure that those are all things that you're on top of. If anyone has any questions, obviously just throw them in the chat. But these are all some things that I thought would be very, very relevant to you guys.
Brian, I threw up a poll there, and looks like we have 28% people that do invest in Robinhood, Acorn, those sorts of things. So I thought I was interested in that.
Perfect. Yeah. And again, I'll throw up my email if you guys have questions after the fact on any of that stuff. Let me know. And I'm not a CPA. I'm not a tax professional. I imagine a lot of your questions are going to be tax related. I can give you some general advice, but a lot of those things we can get you in front of the right CPA as well. If you do have some major tax concerns on anything. So,
Brian, for the sake of time,
yeah.
I want to move on to taxes. What's your next slide look like?
Yeah. We're gonna move right on to this is not as relevant, but yeah, we'll go right into taxes for sure.
Great. And main reason I wanted to move up to that is with name, image, and likeness at the college level, there may be some folks making money now off of that. So wanted to kind of get this slide up there to see those numbers in case anybody's making more than $10,275. But any money you make is taxed. The government wants some of it. So I'll let you talk for a moment, then I might have another question.
Yeah, perfect. So taxes are something we get asked a lot of questions about, and for many of you, it may be the first time you're paying them. One of the things we always talk with our folks about is whether we're a W-2 employee or a 1099 employee. 1099 employees are technically people who are self-employed or contractors, so to speak. A W-2 would be more of your standard salary job or hourly job where you're getting paid a paycheck every week, and they're taking the taxes out for you or withholding taxes. And then 1099 employees are technically are very rarely going to have anything withheld from them other than maybe some Social Security taxes and like that. So W-2 employees are common to get tax returns or actually get paid back by the government. And 1099 employees are likely to owe the government, the IRS, some money, later on. Planning throughout the year, again, for W-2 employees, there's not as much planning needed because Most of the time, the withholding that you have is generally going to be pretty good, depending on how many elections you've taken, as far as or exemptions you've taken on your W-4, and so the money being withheld every week or every paycheck from your from your paycheck is generally going to take care of the taxes you have, and most people are getting a small refund if they're doing that properly. The 1099 employees need to have a good idea of where they're going to fall on this chart, so that they can have an idea of what they're going to owe the government either quarterly or at the end of the year. And so this is the tax brackets that we have for 2022. And so we know we are going to get taxed on every dollar we make. Everything. I don't love how this chart's done. It's really kind of, if we look down, but I would imagine the vast majority of the people on this call are single. So these are the tax brackets or tranches for 2022. And essentially every dollar that we make over our first dollar up to our first $10,275 is taxed right here at 10%. So you can see this line kind of goes here. Once we get over $10,275, we're paying 12% on the next 30,000 or so, all the way up to 41,000. So anything under 41,000 is going to be that blended rate between 10,000 and 12,000. And then once we get over 41,000, the brackets jump up quite a bit. Once every dollar past 41,775 up to 89,000, we're going to go up into that 22% tax bracket, and then over 89,000 into the 24% tax bracket. And then we start really getting up there once we've made over 170, then we get our brackets in the 30s, 35. And then if we're really at the top end, we're going to be paying 37% taxes on really anything over about $540,000 and 40,000. You'll have a standard deduction in here of about 12,500, but you're going to owe taxes on really everything you make this year, guys. And I know Royce brings up, obviously NIL here, brand deals and endorsements. So happy that this is something that was unlocked for student athletes like yourselves. I think it's very un-American that for a long time we have not been able to, sign our name on a piece of paper, and if somebody wanted to buy that was something that was outlawed. Didn't sit right with me, so I'm very, very glad that they've made those changes. But certainly any money that you'd make from appearances or autograph fees or endorsements that you may be doing, would certainly be subject to taxation. The government doesn't care how we make the money; they just want to get paid for it. And so we would combine all of that money together, whether we have a part-time job or a full-time job, and we're doing endorsement deals. All of that money combined is the money we would use, the number we would use for our income tax rates overall. And what's very, very important is a lot of these deals that you may be doing, if you're doing anything from an NIL standpoint, whether it's an appearance fee or an autograph fee or an endorsement, those would very likely be sort of a one-off job and almost certainly be a 1099 payment for which there wouldn't be taxes withheld. That would be a situation where you definitely want to keep some of that money aside, probably equivalent to what you expect to make on this chart, for the year, in order to pay those taxes at the end of the year and not get a big surprise from the IRS.
Brian, I'll also mention all of our folks that get the great opportunity to play professionally. They may, play for one team, get traded, those sorts of things. So anybody that gets that great opportunity, know that not only does federal tax you, but each state taxes you. So for instance, I'm not a pro athlete, at least not anymore. But I work in Missouri and live in Illinois. So Illinois wants my money too, a lot of it. So Missouri comes out of my paycheck through SLU. They say, okay, we'll pay Missouri, but they don't care about Illinois. I have to care about Illinois. So I have to put money aside or take extra out of my paycheck. So same goes for, jobs you might have in by state. But if you're playing on a team in Texas and you get traded to California and get that tax rate, know that it's coming. No, don't be surprised that that every state's got a tax man and they all want your money. So be aware of that, all you pro athletes.
You're right, Royce. And it actually even goes further than that for the pro athletes, because they're technically, even if they're based on a team in Dallas, if they play a game in Minnesota, right, they earned their money during that game in Minnesota, and so Minnesota will for them, and then they play the next game in Illinois or Georgia. Each of those states will likely have a tax bill for them, and so yeah, it gets very complicated. And you'll have hopefully those teams will have resources for you and accountants for you, but those are certainly things to think about and be on top of. And so yeah, it looks like we have some people who are getting some money from NIL, which is that's wonderful that you've been able to take advantage of that. And and do so. But that's certainly something you want to look at as far as your taxes and tax implications for any of the work that you do. Also, if you're doing gig work, if you're driving Uber or DoorDash or something like that, or equivalent, those are almost exclusively going to be 1099 type of situations where we're not getting regular steady pay, and they're not going to be withholding taxes from you. So any of those pieces of income that you have are going to all be relevant to your tax bill at the end of the year. So be mindful of that for sure.
My biggest takeaway from working at this job for 2 years was that the taxes are in the, what is that? It goes up. So like if you make $215,000, you're not getting taxed 35% on that. You're only getting taxed on 35% between 170 and 215. That was a big learning for me. So hopefully y'all took that away as well, as I was like 26 when I learned that, unfortunately.
Yeah, they're called
$200,000, but still.
Right. Yeah, they're called brackets or tranches, and so they come into play in a lot of different ways. And it's never bad for you to earn more, but the more we earn, the higher marginal tax rate we're going to pay overall. So, but yeah, it's a good problem when we have a lot of taxes to deal with, and that's usually something that we'll start work with a financial advisor if we have tax problems, because then we can find some great tax mitigation strategies and then other ways to help you manage your money from that perspective for sure. All right. Does anyone have any questions? And there's my contact information. If you have questions after the fact or you think of anything, and my phone number, you can feel free to text me or call me, or reach out to me via email.
Brian, if you want to stop share, you can.
No, sure.
Actually, if you go ahead and leave it up there so they can jot it down.
Okay. Yeah.
I do have a question.
Yeah.
Real quick. Again, I don't want to take any more time. We're right at time. But the thought I had was, as we get that credit card, right? We get that first credit card, or maybe we already have one, and it's in our name. Maybe we've been living on our parents and their credit card for a while. But when it comes to buying that first car, buying that first house, creditors want to see that you have a good track record and a good credit score. So how can we build that good credit at a young age? What's the smart way to do that?
Yeah, it's a phenomenal question, and it's unfortunately it can be very difficult for young people to build credit, because creditors are hard on us, right? Particularly they're hard on young people, because what they like is they like a proven track record. They like consistency over time, and so we're not able to show them that right away in many cases. And so when we do have that first card and we are able to open that that line of credit that may be a little bit smaller, we want to be extremely responsible with it, and we want to use it very sparingly. When we talk about credit cards in particular, we want to keep our credit utilization very small. And when we talk about credit utilization, we'd be talking about the amount of available credit available to you. So for instance, let's say you get a credit card with an available balance or a credit limit of $1,000. The creditor doesn't want to see you having a balance over about 20% of that. And in fact, they'd like to see that lower. Even if we're maxing it out and paying it off every month, they don't really like that. They want to see our utilization lower. And so what I'd recommend is that we're using that only very sparingly, keeping that utilization to about 20% maximum. And then every 6 months or so, we want to be reaching out to that credit card company and saying, hey, will you review my account? Let's look at my credit history. Hey, I've been using this card responsibly. Are you willing to raise my limit? And by raising your limit, you're going to show more available credit. And creditors like when we have lots of available credit that we're not using. It makes us look more responsible. It makes us look happier and healthier to them. The other thing, as long as we want to open credit cards without big fees or anything like that, there's lots and lots of great options that don't have any fees out there. The other thing is creditors like longevity. They like to see that we've had accounts open for a long time. And so if we have cards out there that have no fees on them, we do not want to close them. We want to keep those open for us, even if we're not really using them, because they want to see us have those cards out there that have big open to buy, a lot of credit in them, and that we're not using much of them, and that also we have a long history of paying them on time. Of course, we never want to get behind in the payments. We don't want to get over our head in them. We don't want to get them if we can't use them responsibly. Would be the number one thing I would say. But yeah, building credit is going to start by doing it at a small scale, doing it in a way that's totally responsible for yourself, and going slowly. But don't get rid of them, and call them every 6 months and ask them to increase your credit limit for sure. Those would be some of the early tips for me.
Great. So be careful of the guy standing at Busch Stadium with a blanket on a cold
Yep.
day and,
Yep.
oh, hey, sign up for this credit card, you get a blanket. Like, don't
No.
do
Don't do it.
Get a credit card, be responsible with it, put your gas and groceries on it, pay it off
Mhm.
months. Make sure you're establishing good credit. And like Brian said, contact them and get the limit raised. But be careful. Don't buy that round at McGurk's. Just
Mhm.
worth it. I know it seems like a good idea at the time, but you can go without that.
Yeah. And I didn't even mention, but Royce said, pay it off every month, of course. You know, as long as you pay it off, your full bill every month, you're never going to pay a penny interest. And so that's a great way to establish your credit and grow it over time. But that is absolutely one of the biggest things you guys can do to help your financial security, because your credit score not only is going to help unlock the things you want in the future, like getting a house or getting that car that you want, but it's also going to impact the price you pay on a ton of stuff. Things like your car insurance will be more expensive if you have a bad credit score. Obviously, any loan that you get, you're going to pay a lot more if you have a bad credit score. And so building and maintaining your credit at a young age is absolutely critical. So I appreciate you asking that, Royce, and sorry we didn't cover it.
Carrie, I'll let you wrap up. And
Brian, will you go to the next slide for me, por favor?
What's that, Carrie?
you click
Next
the next
slide.
slide.
Next slide, please.
Oh,
That was please
my
in
bad.
Spanish.
Oh,
Sorry.
sorry.
I took 12 years of Spanish, so that's all I retained. Well, hopefully y'all took away something tonight. I know I take away a new thing every single time I hear this presentation. So Brian, thank you so much for spending some time with our students tonight. So I included the link in the chat bar just while Brian was chatting too, but I have this funky little QR code up here because I'm super tech savvy. So what we'd love if you all could scan that, submit your feedback of how it went tonight. We absolutely take that into account. There's actually an option there on the back end of it too to submit, excuse me, if you're interested in any other talks or presentations or really resources that our firm can offer. Again, as a recruiter that interviews about 100 students a month, I see a lot of resumes and I do a lot of interviews. So I'd be happy to give that resource to our student athletes at SLU. And then also we do have a nationally ranked internship that we are currently interviewing for that obviously you can always submit there. If you're not from the St. Louis or Illinois area and you're still interested, I can always get you connected to a recruiter in your hometown. So still fill it out. And then lastly too, any full-time opportunities. We are actively hiring in that kind of space as well. So again, SLU is a huge partner with us and I always want to bring those options to you all first as I don't know, just so we can hang out and continue to chat. So again, thanks all for hanging out with us tonight. And that's kind of all I got.
Thanks, Carrie and Brian. We'll let you guys go unless anybody wants to hang on and ask a question that we're too scared to ask on the big group. So I'll see you guys later.